So our new topic is taxation of business income. But before that, I think I gave the class an assignment. So it's just good we review that. So we'll do that very, very briefly. Then I'll start on taxation of business income. Sorry, I had to pick my calc. So the last time we were here, I asked the class to try an assignment question. So we'll briefly go through that. Then I'll introduce the next topic, which is taxation of business income. So the question I had given is April or April 2023. April 2023 is question 3B. April 2023, question 3B. So I want to try that question. Remember, we finished employment income, but I'd given this question as an assignment. So I would just want to go through that. The topic should be taxation of business income. So please turn to April 2023, which I've given as a class assignment. I want just to review that. So April 2023. April 2023 should be question 3B. Question 3B, the question is called 𝐒𝐮𝐲 𝐉𝐨𝐬𝐽. This one is called 𝐒𝐮𝐲 𝐉𝐨𝐬𝐽. So if you can get that question, then we can read together so that we can make an attempt. So this will be, at least in employment, for now. Once we've reviewed this, it was a class assignment, then it will pave way for a new topic. Today we're supposed to start with taxation of business income. So business will include sole proprietorship, partnership businesses, limited company, that type of coverage. That's what we'll be discussing from today going on. So if you have this question, then we'll read together. So the question is April or April 2023. Question, actually it's question 3C, not B. It's question 3C. So this is employment income. Okay, I'll read this. Then we can make an attempt. So the question reads, 𝐒𝐮𝐲 𝐉𝐴𝐬𝐽 is employed as an IT officer by County University. He reported the following details of his income and that of his wife for the year ended 31st December 2020. Somebody has not muted themselves. You need to mute. I did want generally to mute the class because I wanted to give you a class. I don't really have a choice. I wanted to leave the class open in case you want to talk. Yes, I wanted to leave it in case somebody wanted just to talk or express themselves so that it's very interactive, but it's okay. So note 1 says he was entitled to a basic salary, 1,200,000 per annum, and the question says net of pay. Remember the importance of that phrase, those 3 words, net of pay. Remember why we met a similar question, and we said those words are very important. Basically, it means you cannot tax 1.2 million unless you take the 250 and add back the 250 so that it's gross salary. And you only do that when you see those three words, net of PE. If those words are not there, then again, you don't do that. Anyway, we will continue. Note 2 says, the employer provided him with a motor vehicle of 2,600 cc that had cost 2.8 million from August 2022. So there'll be some apportionment because the vehicle was not given from January, but from August. So we are talking about a benefit for 5 months. So August to December is 5 months. So that apportionment must be done. 3, sitting allowance for attending the university meetings at the head office for the year amounted to 120,000, out of which 30% was in relation to reimbursement for travel costs incurred between the month of January 2022 to July 2022. This amount was paid in January 2023. Then 4, the employer had provided him with a house within the university where he lived up to 30th June 2022. The market rental value of the house was 45,000 per month, and he contributed 10,000 per month towards the rent. Then note 5, on July 2022, he moved to his residential house, which he purchased using savings from Home Ownership Savings Plan, HOSP, where he was contributing 8,000 per month up to June. So there'll be some apportionment. So probably housing benefit will have to be apportioned between January up to May, I think. No, up to June, because he moves from July. So housing benefit will only be for 6 months. Then he moves to his own house. So there'll be apportionment of many things. Apportionment of mortgage, apportionment of housing benefit. So you have to keep that in mind. I'm just preparing you mentally. Okay. Something else on the same note, he also obtained a mortgage from Technology Circle to top up the savings from the Home Ownership Savings Plan. For the 6 months, up to 31st December 2022, he had paid 360,000, inclusive of interest of 100,000 shillings for the mortgage loan. Half of this was reimbursed by the employer at the year. Now, 6, Technology Circle paid him 24,000 net as dividend on his shares and interest of 48,000 gross on his deposits. Now, the following deductions were made from his salary during the year: family life insurance premiums, subscriptions to 𝐼CT Association, contribution to registered pension scheme, 8, he enrolled for an online cybersecurity certification course in September 2022, and the employer paid his fee of 60,000 shillings. 9, his wife, 𝗪𝐿𝐼𝐶𝐬, works for an IT consultancy firm where she received a basic salary of 60,000 per month and other benefits from employment as follows. The wife received medical allowance of 15,000 per month. Now, this firm has a medical scheme for all senior employees only, so it's discriminatory. Now, she worked out of office for 7 days to install a human resource management software where she received a subsistence allowance of 7,000 per day. She attended a 1-week training on artificial intelligence master class. The employer paid 120,000 for the training. Her other income comprised part-time IT consultancy. She received 120,000, royalties on sale of literature books, 95,000 net of tax at source, Oscar 𝐉𝐨𝐻𝐃 or 𝐉𝐨𝐻𝐃 and his wife have a tradition of filing tax returns separately to the Revenue Authority. Required, compute the separate taxable income for Oscar 𝐉𝐨𝐻𝐃 and his wife for the year. 2, determine the tax payable, if any, on income computed. So this then should be Mr. and Mrs. 𝐉𝐴𝐻𝐃 because we are computing for Oscar and the wife. So Mr. and Mrs. 𝐉𝐴𝐻𝐃 of Oscar 𝐉𝐴𝐻𝐃. So it's for Mr. and Mrs. and we are preparing a statement. Taxable income. Yeah, and then so let's start with Mr. Oscar. Mr. Oscar 𝐉𝐴𝐻𝐃. So we start from, we bring in every note. So note 1 says he was entitled to a basic salary of 1.2 million per annum, net of pay, those 3 words. So it means his basic salary is going to be 1.2 million, add the 250. So it's going to be 1450 so that you tax it gross. So basic salary is going to be 1.2 million, add the 250. 1.2 million is per annum. The 250 is also per annum. So just add, so his basic salary is 1450. Add like that. Then note number 2, the employer provided him with a motor vehicle of 2,600 cc that had cost 2,800,000, but not from January. This motor vehicle is provided from August 2022. So you must do some apportionment here. So there is a car, CC basis. So CC rating has been provided. There's a question here. There's something. Oh, it's not visible. Okay, I'll try to pull this in front and see whether things will change a bit. Let me just pull the desks in front. Tuone kama mambo yatabadilika. Check whether there's any change. Is it any better? I've just pulled the desk in front. Check whether anything has improved or is it still not visible. Nani alikuwa anauliza? Angalia kama inaweza kuonekana sasa. Is it any better? Ama bado tu? Not yet, okay. I'll pull once again. Even now, the desk is very close now. It's still not visible. Now I don't know what else to do. It's very near the board. You see, this is not like the camera, which can be zoomed in. So we are just using the camera on the computer here. So if that doesn't work, then I don't know what else will work here. Now, is it any better? I'm waiting for whoever was asking. I'll pull the desk very close to the table. It's better now, you can see. Okay. I hope that helps. Let me pull it again slightly more. I hope that helps. Unfortunately, I can't change the lights because it's only one. If there was an alternative, I would have tried changing. So now that it's a bit visible, I hope that helps. So we can continue. So there's a car. The car is not 2, but from August. So 2,600cc, you check the rate that has been prescribed, usually is given. So if you check under motor vehicles, 2,600cc is between 2001 and 3,000cc. It's 8,600 per month or 103,200 per year. I will use the monthly one because it's 5 months. So I'll say, or even use the annual one. If I want to use the annual one, I'll take 5 months over 12. August to December is 5 months. So 5 months over 12 times 103,200, because 103,200 is per annum. Alternatively, I would have taken the monthly rate. The monthly rate ni ngapi? 8,600. And I would have multiplied by 5 months. Either way, uchukue annual ufanye apportionment, ama uchukue 5, you multiply by 8,600, you'll still get the same answer. And this has to be compared. So 5 divided by 12 times 103,200 is per year. Now that gives us 43,000. Ama useme 8,000 ni 8,600 per month, yeah. Times 5 months. You should still get the same thing, eh? The 8,600 ama ni ngapi? Yeah, 8,600 or 103,200. We should be able to get the same thing. So 5 divided by 12 times 103,200 gives us 43,000, not 43,200, but 43,000. Ama uchukue 8,600 times 5 months, utapata hiyo. Now that you will compare with the prescribed rate. The prescribed rate is 2% of the initial cost of the car. The initial cost of the car is 2,800,000. So 2,800,000. 2% is per month, so I'll multiply by 5 months. 5 months because it's from 1st of August to 31st of December. So that should be 5 months. So this will be 10% of 2.8 million is 280,000, 10%. Then I put that, I'm comparing. So I'll pick the lower or the lowest. No, the highest, not the lowest, but the highest for benefits. The highest is 280,000. So the highest in terms of comparing these two is 280,000, and that's our motor vehicle benefit. 280,000 is the highest amount there. So we are done with note 2 for the motor vehicle. Note 3, sitting allowance for attending the university meetings at the head office for the year amounted to 120,000, out of which 30% was in relation for reimbursement for travel costs incurred between the month of January and July. This amount was paid in 2023. So this travel cost that was not paid immediately, but will be paid in 2023, will be taxed when it is received. So employment income is taxed on a cash basis, not accrual. So you don't accrue. So the 30%, which is reimbursement for travel, which has not yet been received, will not be included. So we'll only take the sitting allowance of 70%. All allowances are taxable. So I'll bring in sitting allowance, except the 30%, which is traveling, reimbursement of traveling. So sitting allowance. So sitting allowance will take 70%, because 30% is reimbursement of travel, which will be paid next year. It was paid in 2023. So it will be taxable when it is received, not on accrual basis. So times 120,000. So that is what we'll tax out of the sitting allowance. So let's start this. Let's tax this. So 0.7 multiply by 120 is 84,000. So sitting allowance, 84,000 shillings. That will be sitting allowance. Note 4. The employer had provided him with a house within the university where he lived, but only up to June. So you must also do an apportionment for housing benefit. He lived up to 30th of June, so that's 6 months. The market rental value of the house was 45,000 per month, and he contributed 10,000 per month towards rent. So as usual, housing benefit will be based on the total gains from employment. So we will leave housing for the moment until we have total gains. Then we can come back to this note on housing. We'll come back to note 4 shortly after all the other gains have been included. So we go to note 5 in the meantime. So in July, he moved to his residential house, which he purchased using his savings from home ownership savings plan, where he was contributing 8,000 per month, but up to June. So contribution to home ownership savings plan will be allowed as a deduction, but again, that will be apportioned for only 6 months, because after the 6 months, he makes a withdrawal and he buys a house, to which he moves from July. So we'll make that adjustment. We'll be making those adjustments. So note 5, allowable deduction up to June. We leave that for the moment, only for the moment. He also obtained a mortgage loan from Technology Circle to top up the savings from home ownership savings plan. For the 6 months up to 31st December, he paid 360,000 inclusive of interest of 100,000. So the interest for the 6 months, the mortgage interest for the 6 months, again will be allowable as a deduction. So let's do the deduction shortly after all the gains have come in. So we leave the deduction kwanza. Just for now, for the mortgage loan, half of this amount was reimbursed by the employer at the year end. Okay, the employer's reimbursement of mortgage will be a benefit. So the employer reimbursed, okay, that sentence says, for the 6 months up to 31st December 2022, he had paid 360,000. Now that 360,000 for mortgage loan, half of 360,000 was reimbursed by the employer. So this mortgage repayment, the amount reimbursed by the employer is half. So that would be half of 360. So half of 360,000 is 180. 180,000 is a benefit, because it was paid for him by the employer. Remember, under cash benefits, one of the cash benefits is any payment towards mortgage or insurance on employee's behalf by the employer is a taxable benefit. Then note 6, Technology Circle paid him 24,000 net as dividends on his shares and interest of 48,000 gross on his deposit. That's other income. Let's deal with one specified source at a time. We first finish with current employment. The following deductions were made from his salary during the year: family life insurance, subscriptions to ICT, contribution to pension scheme. 8, he enrolled for an online cybersecurity certification course in September 2022, and the employer paid his fee of 60,000. We said payment of fee is usually conditional. The condition for it to be allowable or non-taxable income is that the employer must pay tax. If the employer pays tax on the school fees, then it will be allowed as a deduction. Now, in this question, there is no evidence. In this question, there is no evidence that the employer paid tax, so we'll tax him on school fees paid by the employer. There's a language the examiner can use, and you know that the employer paid tax. That language is not here. The language is like this. If the examiner tells you the employer did not use the school fees as allowable expense in its income statement, meaning the employer did not deduct it. So it means the employer paid tax. That language is not here. So this school fees that was paid in September, I'm going to include this for cyber security certification course. So cyber security course fees. So these fees has been paid by the employer. And there is no indication the employer will pay tax, so we'll tax it on him as a benefit. So 60,000. The rest of the incomes belong to the wife. So this list we have here is the employment income. It will allow us now to go to and calculate housing benefit. So before we calculate housing benefit, let's add this to get the total gains from employment. So I want us to add this to get the total gains from employment, which will help us to calculate housing benefit. So let's just add this. So far, 1450,000. We add 280,000. We add 84,000. We add 180. We add 180,000. We add 60,000. And this gives us 2054. Now, 2054,000 is what we had called pensionable pay, total gains from employment. So our housing benefit will be calculated based on that. So we'll say housing benefit. And remember the apportionment. So housing is provided up to 30th June. That is note 4. Up to 30th June. So we'll do the apportionment. It will be for 6 months. All right. So housing benefit, I'll say 6 months over 12, 15% times total gains from employment, 2054,000. First get that. So we'll say 6 months over 12. Times the rate of 15% times 2054,000. That will give us 154,015. That's 154,015. Then what do we compare with? We are still in note 4. The market rental value of the house was 45,000 per month. So we compare this with market rental value. $45,000 per month should be 540,000 per year. Then you compare these two. So out of those two, you will choose the highest. So you say HB, short for housing benefit, is the higher. So the higher amount is 540,000. So from 540, you must lessen the nominal rent or his own contribution towards rent will be subtracted from there. So we'll say less his own contribution. Oh, yeah. We should also apportion this, the 45, you're right? So the 45 is also apportioned for 6 months. So it's not market rental value. So it's not 540, it's 270. This is 270. Market rental value is also for 6 months. So 270,000. So that's 45,000 times 6 months. Yeah, 270. Thank you very much for that correction. So the higher is still 270. We lessen his own contribution. So there is some rent that was being deducted. The rent is in note 4, 10,000 per month for 6 months. So his own contribution is 60,000, 10,000 per month. So what is left is 210. That's the housing benefit, 210,000. So minus 60. So once we are done with housing benefit, next we make the allowable deductions. We bring all the allowable deduction and remember to apportion because of the timing. So we'll do the apportionment here for the allowable deductions. We'll do the apportionment. So what's the first allowable deduction? The first allowable deduction is, I think, note 5. Note 5. Note 5 says, on 1st July, he moved to his residential house, which he had purchased using his savings from home ownership savings plan, where he was contributing 8,000 per month up to June 2022. So less contribution to registered home ownership savings plan, RHOSP. So the actual contribution was 8,000 per month for 6 months. Up to June, that's 48,000. The maximum or set limit is also 8,000 per month for 6 months, is 48,000. So they are just the same, but you're supposed to deduct the lowest between the two. That's why we are comparing. So we deduct 48,000. Then the same note still, for the 6 months up to, okay, that's home ownership, he also obtained a mortgage from Technology Circle to top up the savings from HOSP. For the 6 months up to 31st December, he had paid 360,000, inclusive of mortgage interest of 100,000 for 6 months. So there is mortgage interest. So again, we have actual. So the actual actually for the 6 months was 100,000. That is what was paid up to June. 100,000 as given. This was not annual, but what he had paid up to June. Now we'll compare with the maximum allowed set limit. So set limit for mortgage is 25,000 a month times 6 months. So set limit will be 150. Out of this, you deduct the lowest. So we have, for 6 months, it's 150 actually. The lowest would be 100,000. That's another allowable deduction for mortgage interest. Then note 6, Technology Circle paid him 24,000 net. So that's other income. Let's first finish with employment. Note 7, the following deductions were made. Family life insurance premium was deducted from his salary. So that will allow him to get insurance relief. Insurance relief is a set-off. You offset directly from tax. So when you're calculating tax, we'll remember to deduct 15% to offset. Subscriptions to ICT association, so it's an IT person. So these subscriptions to professional association, so you see subscriptions to IT association. He had subscribed 16,000 during the year. So deduct subscriptions is allowable deduction. Contribution to registered pension scheme. Contribution to registered pension. You're going to take actual contribution So actual contribution was 300,000. We'll compare with the set limit. Set limit is 20,000 per month or 240,000 per year. We deduct the lowest, 240. And this should now give us the subtotal from employment, only employment. That will be the total from family insurance is not a deduction. There's a difference between a deduction and a set-off. A set-off is offset from tax. A deduction is deducted from income. What we are deducting here are allowable deductions, not set-offs. Set-offs 𝐼𝐻𝐼𝐴 𝐷𝐵𝐴. Set-offs are offset from tax. Insurance is not deducted from income. It's a set-off from tax. So there's a difference. So we'll get the subtotal for employment, 254,000. Add 210. 210,000 minus 48,000 minus 116 minus 240 to get 1860. $1,860,000. That's income from the current employment. So income from the current employment is 1,860,000. So at this point, you look for other incomes. So where are the other incomes? The other income would have been note number 6. Note 6 says, Technology Circle paid him 24,000 net as dividend. So dividend income is subjected to withholding tax of 5%. Withholding tax is the final tax. Final tax means you don't tax that income again. So dividend income, withholding tax of 5% that was deducted at the source is the final tax. No further taxation. So that means ignore that income. So that's one. Do we have any other income? Same note, note 6, on his shares. Then there's interest of 48,000 gross on his deposits. So which deposits? You make deposits in a fixed deposit account or, mostly fixed deposit account in a bank. So even for deposits or even money market funds, there's a withholding tax on interest. The withholding tax is 15%. It is the final tax. You don't tax it again. So does Oscar have any other income? I think we are done. There's no other income. We've said whatever else is there, like dividends, withholding tax is the final tax. Whatever other income is there is for the wife. So we'll close his at 1860. So that is his total taxable income. So this ends here. This is what you call taxable income. That's the taxable income for for Mr. 𝐸𝐵𝐺𝐻. Now, we want to compute for the wife, Mrs. 𝐸𝐵𝐺𝐻. So you come here and see Mrs. 𝐸𝐵𝐺𝐻. Yes. Yeah, it's good. So you have Mrs. 𝐸𝐵𝐺𝐻. So 𝐸𝐵𝐺𝐻, the wife, look at note number 9. Note number 9, eh? So his wife, Erica 𝐸𝐵𝐺𝐻, works for an IT consultancy firm where she received basic salary 60,000 per month and other benefits. So we'll include basic salary here. $60,000 per month. We multiply that by 12 and we get 720,000. That's basic salary, 720,000. What else? Medical allowance. Allowance is cash, eh? It means she's given cash every month, an allowance, whether she uses it for medical or not, she's paid that. So there is medical allowance. So there is medical allowance of 15,000 per month. The firm has a medical scheme for all senior employees only. So medical is discriminatory. So we'll say medical allowance. So medical allowance, how much does she receive? 15,000 per month. Eh? We'll say 15,000 multiplied by 12 months. I think we get something like 180,000. So that's medical. What else? She worked out of office for 7 days to install a human resource management software where she received a subsistence allowance of 7,000 per day. So subsistence allowance is what we call per diem, if you remember. So the first 2,000 is exempted. Anything above 2,000 is taxable. So there is this subsistence allowance of 7,000 per day for 7 days. Eh? So we'll say subsistence allowance . Subsistence allowance, she's being paid subsistence allowance of 7,000 per day. So 7,000 per day minus 2,000 per day. 2,000 per day is allowable. Now 2,000 per day, we multiply by this number of days. How many days? 7 days. So for each day, 2,000 will be exempted from tax. So 5,000 times 7 is 35,000. That is taxable income. This is supposed to be 7 days. Right? What else? She attended a 1-week training on artificial intelligence masterclass. The employer paid 120,000 for the training. So again, that is, there's no indication the employer has paid tax on it. So we'll tax her on the tuition. The tuition fee will be taxable income. So we continue there. So there is training. This training is for artificial intelligence. So there is AI training. So AI training, the employer pays how much? 120,000 for AI. So I'll add here 120,000. That's training for artificial intelligence. 120,000. AI training is 120,000. Royalties on sale of literature books is 95,000 net of tax at source. So what is royalties? Royalties is income you get from intellectual property rights. So intellectual property is not physical property. Rent is physical property. Intellectual property is like copyrights of a book, like entertainment, like what you see in 𝐒𝐿𝐴 Live by comedians, like this thing, the street. So royalties is what is paid for comedy, you write a book, those are copyrights, something like that. So royalty is taxed twice. Withholding tax at the source is, let me just put a note here on royalties. So royalties, for a resident person, there's a withholding tax rate of 5%. So ukiambiwa ni net, tayari wametoa 5% withholding tax. So what is left is 95%. So you're asking yourself, if 95% of the royalties, after deducting 5%, if 95% is how much? 95,000. What about 100%, which is the original gross amount? So 100% of royalties will be 95,000 divided by 95 times 100. I think that will give you the original amount of 100,000. That's what you bring to tax. So say here royalties, and the royalties must be gross. So the gross amount is 95,000 divided by 95 times 100. So that will give you 100% of the royalties, which is 100,000. Oh, and I've left part-time IT consultancy. So we also have consultancy. Consultancy of 120,000. And I think that is all. So just add the total taxable income of the wife. So let's add these incomes. So she has a salary of 720,000. There's a medical allowance of 180,000. The subsistence allowance of 35,000. This AI training of 120,000. There's royalties of 100,000. There's consultancy of 120,000. So for the wife, we have 12,75,000. So you can confirm that. That's what we call taxable income. So that's the first part, the Roman 1, to C Roman 1. Now we want to look at the next part, which is computation of tax. So for Roman 2, we look at tax computation. The tax computation will start with Mr. Oscar 𝐸𝐵𝐻𝐻, or just Oscar 𝐸𝐵𝐻𝐻. So we are now calculating tax. We'll start with Oscar 𝐸𝐵𝐻𝐻. So his income is 1860,000. So we'll say on the first. So these scales are usually given. So the first band is 288,000. The rate will be 10%, which gives us 28,800. So that's the first line. Then you go to the next band. We call them bands. So the second band is from, I think, 288,001 up to 388,000. You take the upper limit, 388,000 minus the upper limit of the first band. That will give you the next 100,000. So 100,000 will be at 25%. The third band, again, you take the upper limit of the next point there. Actually, we don't even need the upper limit because what we have is little, is only 1860. So I'll just say the next 1860,000 minus these two. 288,000 plus 100,000 is 388,000, what we've already taxed. At the next rate is 30%. So I'll get the difference. 1860,000 less 388,000. Now multiply that by 30%, and you get 441,600. So we add, we'll get a gross amount of 495,400. Now this is when you do what I had called set-offs. You offset any taxes that were already paid. This is the time you do the set-offs. This is the time you get 15% of insurance, called insurance relief. This is the time you deduct those. So we'll start with the tax itself. Utasema less tax at source. The payee itself first, if there was any payee. So the payee, you'll get it in note 1. Those payee of 250,000 per annum. So I deduct 250. What I'm doing is set off, or I'm offsetting. So there's a difference between allowable deduction and offsetting. Now we are doing set off or offsetting. Next, I will deduct insurance relief. So insurance relief is a set off. It's supposed to be 15% of the total premiums paid. Total premiums paid for insurance you get in note 7. Family life, 48,000. But the maximum you can offset is 60,000 per year or 5,000 per month. Now this cannot reach that, so I'm just deducting 15% of 48,000, but I should not get more than 60,000 or 5,000 per month. This is 7,200. You offset that. Then I had taxed royalties twice. Now I must deduct withholding tax on royalties. So I have withholding tax on royalties. So withholding tax on royalties, you take 5% of the gross amount you had included. The gross amount we have calculated was 100,000. So what was paid at source was 5,000. Then there's also withholding tax on consultancy. Consultancy fee, there's withholding tax of 5%. Consultancy is 120,000. We simply did not calculate the gross amount because the examiner did not say it is net. You only do it when the examiner has told you so. So 5% of 120 is 6,000. Then we also deduct personal relief. So personal relief is 28,000. So tax payable is 495,400. Now we deduct all the set of taxes. We deduct the set of taxes here. Uh, 495,400 minus 250, that was payee, minus insurance relief, 7,200 is set off, minus withholding tax on royalties, 5,000, minus withholding tax on consultancy fees, 6,000, minus personal relief, 28,800. The net is the tax payable of 198,400. So that's what we call tax payable. Then we also tax the wife, Mrs. Anajiita nani? Anajiita Erika Ebala. I'll just call her Erika Ebala, the way the examiner is calling her. We do the same thing. Our total income is 1275,000. So we say the first 288,000 at 10% gives you 28,800. Then you say the next band, the next tax band, just like above there is 100,000 at 25% is 25,000. Hata hatufiki, it's 1275, tutafika tu. So next itakuwa 1275 per income minus 388,000 at 30%. This is 266. So you add everything. Then you bring her own set of taxes. We are not told she paid any tax at source, so we'll not worry about that. Nimekosea pakubwa. Hizi royalties hazikuwa za Ebala, zilikuwa za the wife. And nobody told me that. Yake ni insurance peke yake. Hii consultancy, withholding tax, hizi nilikuwa nachukua hapa juu ni za the wife. These are not the husbands. Iko kwa income ya the wife bwana. So ya Ebala is only insurance. nimetoa pale insurance, and then unatoa after insurance unatoa personal relief. I was picking somebody else's deductions, 28,800. So hizo ndio za Mr. Oscar. Hizo zingine ni za the wife. So 495,400 minus 250,000 minus 7,200. Oscar hana nini hizo deductions zingine. So yake ni 209,400. 209,400, hiyo ndio tax fare. So I have to redo the one for Erica, but I'll just write the same thing. So we do for Erica, hiyo ndio ya the husband. Now we do for the wife, Erica Ebala. So we're going to say on the first, 288,000 at 10% is 28,800. We're calculating their taxes separately, just like income was separate. Then the next 100,000 at 25% is 25,000. Then we just get the excess. Erica's income is 1275,000 plus 388 at 30%. So 1275,000 plus 388,000 at 30%, 266,100. We add that plus 53,800. We get 319. So hiyo ndio gross tax ya the wife. So our set-offs ni withholding tax. Hatukuambiwa kama amelipa payee. So you only use the information you've been given. So utasema less withholding tax. WHT, there's withholding tax on, for example, royalties. Unachukua 5%, 5% of the gross amount, 100,000. So deduct 5,000. Then she also had consultancy. So that's 5% of 120,000 is 6,000. Then you deduct her personal relief, and we are done. So let's deduct her personal relief. $28,800. What remains is tax payable by the wife. So 319,900 minus those deductions, 11,000 minus 28,800. This is 280. One done. So that's end of question. If there is any question you want to ask, otherwise that's about where we reach with the employment income. Now I'll introduce the next business or the next topic, which will be taxation of business income. So do we have any question?